This is our Forex blog for January 11th, 2012, and we use the currency meter, which statistically compares every currency to every other one on multiple time frames. On the top, this histogram is made up of 5 different tools. 3 of them measure the direction. Is the dollar just simply going up or down versus all the other ones? And that percentage is built into this. And we also use 2 indicators that measure the intensity on a bar-by-bar basis compared to the last 20 days intensity for that time of the day compared to each currency. We also use about a 30 to 45 minute intensity. So all 5 of those indicators are averaged together into one simple to easy to read indicator. Underneath that we have the daily, weekly, and monthly trend. So in a nutshell, if you see a lot of strength like this coming into last night at and above the 80 level, and then you see a pullback, because markets don't usually just go up or down for 10, 12, 15 hours at a time. They'll go up for 30 minutes to 3 or 4 hours, and then they'll have a 15-minute to 2 or 3 hour pullback, and then usually that previous momentum continues. But if you see this pattern like this, typically the strength will resume. Now, I personally try to focus on currencies where the weekly trend is in the direction of the previous move. So here we have a very strong move up, followed by half an hour of weakness. However, the weekly trend is down. You can still take trades like this, but keep in mind that if the weekly and monthly trend are against in the opposite direction of what the real-time momentum is, it's usually, if that momentum continues, it might only last for an hour or 2 hours. And you can see right here, that's what happened. You have 1 hour of strength followed by a little bit of weakness again. You're always better off when you see a currency like the pound with a lot of weakness followed by a half an hour of strength right here, less strength than weakness, when all the time frames are down. This is a very high, in my opinion, a very high winning percentage trade because all the time frames are lined up, and when you see the strength starting to fall off like this, usually it goes weak, and you can expect most of the time about an hour to 2 hours of weakness coming back in if it's one of the weakest currencies. So that being said, coming up to 430 right here, what was a good one to trade against it? You want to find the strongest one. Well, this one's not that strong at the time, neither is the dollar. The Australian is strong on all time frames, and the New Zealand is too, except it was weak at that time. So I would have been focusing on selling the pound Australian at that time. Let's bring up the chart. Coming up to 430 right there in the pound. Here's 430, and you can see that this currency was going down. You had this nice little pullback right here. You actually would have probably got into this trade at 425 right here when it broke the price. I always draw trend lines on the pullback trades. You put your stop 1 or 2 pips above here, and most of the time you want to draw your fibs, and this is an excellent place to get out of your profit right down here. You know this level, 1.4956 ahead of time. You're short this somewhere around 96 with your stop at 07. You got about 12 or 13 pip stop, and if it goes to your profit target 96 to 56, you got a 40 pip potential profit. The key to trading is small losses, big wins. If you have 6 to 15 pip losses and 15 to 50 pip wins, once the currency starts moving your way, you always want to move your stop down. Once it moves 8 to 15 pips your way, you move your stop to break even. Trades that don't work, because you're waiting for the price to start moving down to get in, usually the momentum of that move, when you're trading a weak currency versus a strong currency, usually it moves 10, 15 pips your way, and so you can move your stop to break even, and oftentimes that's the worst case scenario. Later today, the yen, which was weak most of the day, showed some strength here, and then the pullback phase has a little bit of weakness. Because the longer time frame trend is up, the weekly trend's just slightly up, the monthly trend's up, this momentum is likely to continue. So at 8, you'd be looking to buy the yen versus one of the weakest ones. So the euro was weak before that, but it had 1 5-minute bars of strength right here, and the pound was weak. So I personally would have chosen the pound yen coming up to 8 to sell. Weak pound, strong yen. It's the higher odds of the two. Let's bring this up. Pound yen chart right here coming up to 8. You can see it fell underneath our lower containment band. This is kind of an iffy and slightly risky trade because when currencies are underneath the lower containment band, they can, maybe 1 out of 6, 1 out of 10 days it will continue to trend that direction. The majority of the time when the currency is underneath the lower band, it will have a reversal and work its way most of the time back up to the hourly. So at this point, at 8 o'clock right here, you had a little pullback. You want to wait for price to always confirm your entry. Don't just short don't look at the currency meter and just decide to sell, because it can go all the way up here and you could have a much more advantageous entry price in your trade. Put your stop 1 or 2 pips above here, and again, the Fibonacci areas don't always get hit, but they do make excellent profit targets. And they also are used to decide whether to take the trade. Are you going to risk 10 or 15 pips? If so, where are your likely profits? Well, the previous swing low, the double bottom area right here, it's about slightly bigger number of pips away than your stop. And when a market goes down and hits the previous low, and in this case it hits our trading zones, there's a monthly pivot level right here. If it doesn't have that much weakness, myself personally, I would have been out of this trade somewhere around 25. So would have only made about 15 pips, and I wouldn't have re-entered it here. But this currency, grew in weakness and it continued down. 10 pips a day, if you achieve that on average every day, 30 pips one day, 10 pip loss one day, 15 pips the next day. 10 pips per day, 50 a week, 200 a month, doubles your account with low risk every 2 months. So it's nothing to shake a stick at getting 15, 20 pip wins. Here we have the Swiss, which was previously also doing a counter trend move up. Then you had some weakness right here, followed by almost no strength. It's very high odds most of the time to find this pattern. At 6 o'clock, you're looking to sell the Swiss. What was strong at 6? The dollar was the strongest of the two main pairs, so we'd be looking to buy the dollar Swiss going up on 6. And as you can see right here, this is a wonderful trade. This is what oftentimes happens. This currency, when it's underneath the hourly, it's more likely to go down. When it's above the hourly, it's more likely to go up. A lot of times currencies go up to resistance areas, in this case the previous day's high. It's a very key resistance area, and there is some selling here. When it breaks out of that area, you go long somewhere around 6.15. So you had to watch this currency for 15 minutes, and then you got in somewhere around 95.13 with your stop a few pips underneath these lows. So you're risking less than 10 pips here. And this wasn't really much of a big move up. And notice the upwards momentum, the real-time momentum was up. The daily trend's very strong up. The weekly trend's very strong up. The monthly trend's strong up. So you get into this trade, and I'd be looking to possibly get out of half my trade here. However, it's extremely strong. It's at plus 100 strength. So I'm waiting for this to kind of run out of steam. I would have got out of half this trade up here at the upper containment band. We have some counter trend signals. And you probably want to let the trailing stop get you out of the second half at 45. So your net exit somewhere around 45. You're in this at around 15. You made 30 pips while risking 8 pips, and it doesn't take a math genius to know that you don't even have to be right 50% of the time with these kind of win versus loss ratios to net profits, and that's the key. And once a currency moves up, a lot of times it will make a two-wave pullback. And this one pulled back right here. If you draw your fibs on there, most of the time, if a currency is extremely strong and it's in the daily, weekly, monthly trends up, this is called our Elliott two-wave pullback. Most of the time, it will pull back if it's very strong to the 1.382. The bigger the first wave, the more likely the first one is to get hit. This is not much of a pullback here. Maybe pulled back about 20 pips, so it's a little bit more likely to hit the 1.618. If it had the first wave down and pulled back something like this, then the first 1.382 fib target is more likely to be hit. I like 25 to 30 pip first wave pullback. So this one only pulled back 20 pips, so it's more likely to hit the 1.618. Typically, what happens is, they'll come down to this level and go sideways for a couple bars. I typically will buy it as soon as it goes above the previous bar's high right here. So somewhere around 95.28 with my stop right underneath the low here. So I got about a 15 pip stop here. And again, the profit target, you have the previous month's high up here, the previous swing is 61. So 48 to 61 is your likely profit target. This one went up and kind of ran out of steam up there. Anytime it hits resistance area and can't continue up, you always want to exit half the trade. And more than likely, I would have got the second half underneath this bar's low at 43. So out at 43 and 47, so the average exit is about 45. We're in this at 29. We made about 16 pips while risking, 10 or under. And that meets the risk versus reward criteria that you should have.